Chapter 10 deals with accounting for long-term liabilities, and specifically, it spends a lot of time discussing bonds. We'll talk about the basics of bonds first. Bonds are a way to finance a corporation. So if a corporation needs additional money or additional capital to carry out any of its projects, to expand, if it needs additional money for any of its operations, it can get that funding in a couple of different ways. So one of those ways is by owner investment. And so if a corporation in that case is looking for owner investment, then they would choose to issue stock. So another way that corporations can do that is through issuing bonds. Bonds are basically loans. So they're considered a liability, they're considered debt, so they can be short term for purchasing goods on account. And that type of funding or financing can also be extended from a company, another company itself, for example, a supplier, someone that the business purchases inventory or supplies from. Long-term debt would be considered bonds or notes payable, and then equity financing is considered issuing stock, like I had mentioned before. Bonds specifically are a liability. They are a type of, like I said, almost like a loan, but they are an interest-bearing note. One thing about bonds that's a little bit different is they require periodic interest payments to the bondholders. And then the company pays back the full amount of the principal at the maturity date. So there are periodic interest payments. Then at the very end or at bond maturity, that's the end of the term, the company then has to repay the bondholders the amount that they paid in to purchase the bond. So as an example, a 12% bond would require the company to pay 12% interest every year. Bondholder claims on the corporation's assets rank ahead of stockholders. So if for whatever reason the corporation has to liquidate, bondholders would get their investment back before stockholders would, because bondholders are considered creditors of the corporation instead of owners like stockholders are. Here's some additional comparison between stocks and bonds. So a stock, looking at the meaning of a stock versus a bond, a stock carries ownership interest and it's issued in exchange for cash. So that's one of the primary differences, is that it carries ownership interest, whereas bonds do not. Bonds are simply a debt that involves interest payments and then final principal repayment. With stocks, looking at the return on investment for purchasing stock would be a dividend, but a corporation does not have to declare a dividend. Whereas with a bond, the corporation does have to pay interest payments over time. So with stock, there is not necessarily a guaranteed return, but with a bond, there is. Owners of stock are called stockholders. Owners of bonds are called bondholders. Stockholders are owners. Bondholders are lenders. Stocks are risky because you might invest and then never get a return from it, no dividends ever declared. Whereas with bonds, they're a lower risk because part of the bond contract or the bond indenture is that the corporation has to pay that periodic interest. So benefits of being a stockholder are voting rights, because you are technically an owner, even if it is one tiny minuscule one share of an owner. Technically you are one of the owners of that corporation by purchasing stock. With bonds, the benefit is that, like I mentioned, if the corporation liquidates or whatever, The bondholders will get their repayment first before any dividends are issued to stockholders. Just mentioned a couple of these advantages and disadvantages. So just to review the advantages, bonds don't affect owner control. Interest on bonds is tax deductible, and of course a corporation is looking for any deductible expenses to lower the income that they'll have to pay taxes on. Bonds can also increase return on equity because bonds do not affect equity in the same way that stocks do. Disadvantages, bonds have required repayments, so that periodic interest and then also the full value, the par value at maturity. Bonds can increase returns on equity. So the nature of bonds payable, corporate bonds, when you're looking across the board to invest in a corporation, you're looking at different bonds. They can have different face amounts, interest rates, interest payment dates or terms, and then maturity dates as well. So sometimes if you want to invest in a corporation, you'll shop around for what the most valuable investment would be for you. Some key terms that go along with bonds. First of all, the principal is also considered the face amount of the bond. The face amount is, for example, if the corporation is issuing a $1,000 bond, that is the face amount, and that is the principal amount that an investor would have to provide to the corporation when they are selling for the par value, and we'll go over that in just a minute, of the bond. So the amount, the face amount, that's what has to be repaid on the maturity date, typically in multiples of 1,000. And the interest terms, interest can be paid annually, semi-annually, or quarterly. The bond indenture is the actual contract between the company and the bondholder. The interest rate that goes along with that bond is called the contract rate. So we're going to talk about another rate in just a minute, but know that the interest rate that is specific to that bond is called the contract rate. Two most common types of bonds are term bonds. They all mature at the same time. When you do like a huge issuance of bonds, they will all mature at the same time. Then the corporation has to repay all of those investments back to the bondholders at the same time, whereas serial bonds mature over several different dates. So like periodically they will mature, and that's a little bit of a cash flow advantage for the corporation having to pay out that face amount to the bondholders. This is an illustration showing the transactions that occur between the investor and the bond issuer. Remember, the investor is technically a lender at this point because bonds are a type of note or a type of liability or debt that has to be repaid. So what initially happens is the investor provides the principal amount, so the amount that they're loaning to the corporation, to the bond issuer. After that, based on what the contract is that goes along with that bond, the bond issuer will pay periodic interest rate or interest payments. So for example, if it's annually, then they will pay year 1 of interest, year 2 of interest, year 3 of interest, until finally the bond matures, meaning that the principal amount, so the amount loaned, has to be paid back to the investor. And this is another way of illustrating that, just showing that the bond, maybe if it has a term of 10 years, for example, the face amount of the bond is what is repaid at the maturity date. then between those two times, the interest payments are made.